Hi there, everyone. Good morning. This is Debbie Skora with Asset Exchange Company. Just wanted to point out a few things to you. Firstly, I wanted to thank you for being here this morning to get some information on 1031 exchanges, and hopefully I'll be able to answer a lot of your questions or give you some valuable information that you can use in your business, whether you're an investor or a real estate professional. And I think I have everyone muted, but if you're not on mute, if you could just go ahead and mute your line, that'd be great. That way we won't get the barking dogs and ringing phones and all that. I'm the worst offender in that case, so I apologize if any of that takes place while we're on the call. There's also a questions panel on the right side of your screen. So if you have a question that comes up, just go ahead and type it in. I will try to answer those that are relevant to what we're covering in the webinar. If it's something that's really, really specific to your situation, I may just email you or call you afterwards and talk to you about it. But please feel free to ask questions as we go along. Also, please take a moment to like us on Facebook if you're on Facebook. This is partly how we keep these free for everyone, as we do most of our marketing in social media and by email. So just real quickly, I want to make sure everyone can hear me. Can some of you let me know if you can hear me so that I'm sure that everybody has the audio part of the webinar going fine? So if you could just type something into the questions bar, that way I'll know that people, awesome, great, thank you very much. All righty, so as I mentioned, I am Debbie Skora with Asset Exchange Company. This particular webinar is on problems and pitfalls. So if you have done one of my workshops that I do around the Los Angeles area, or if you have taken one of my webinars before, we're going to go a little bit more today into the stuff that can go wrong. Not to be negative, but it's something that does need to be talked about, and if people are aware of these things and can keep their eyes out for these situations, it can save them a lot of grief and a lot of taxes in the long run. So that's why we're here. I am the local Los Angeles contact for Asset Exchange Company. I have a background in real estate working with investors, and I'm an investor myself. I've been buying and selling properties since I was about 20, and I won't tell you how long ago that was, but anyway, it's been a passion of mine for many, many years, and hopefully I can help you with that as well. Asset Exchange Company is one of the largest independent exchange accommodators in the U.S. And what that means is that we are not tied to a title company or any of the bigger companies that some of the other exchange accommodators are. And we're also not a real small mom and pop company, which a lot of qualified intermediaries are as well, maybe just a single person sitting in an escrow office doing the business that comes through. We actually do nothing but 1031 exchanges. That is our entire line of business. We do more than 2,000 per year. And in the 11 years we've been in business, we've done over 25,000 successful exchanges. Through one of our partners who is a licensed tax attorney. We are a member of the California Board of Accountancy, and we are also a member of the California State Bar. We are bonded and insured, and that means that your money is safe against theft and also errors and omissions. And in those 11 years, we've never had a claim against either one of those insurances. So why is all of this important? Well, there's a lot of things that can go wrong in an exchange. We're going to talk about some of these topics today, things like what happens when someone tries to fudge on their exchange a little bit to make it work, to make it fit their situation, and winds up committing tax fraud, property qualifications, things like not adhering to timelines, and having problems with keeping cash out of the sale that would later become taxable that they're not aware of. So we're going to talk about all of these different topics. And again, if you have something specific that you would like to talk about too that's not on this list, go ahead and put it in the questions and I may be able to cover it as well. So first of all, the thing that's important to understand is, what is a 1031 exchange? Well, 1031 refers to the section of the Internal Revenue Code, which allows for you to sell an investment property and defer the taxes on the capital gain by following a very specific process and buying another investment property. And there's a few different things that are specified in order to make this process allowable. And this is where a lot of people get into trouble because they want to make other things fit into the 1031 exchange process. There's a couple of words in here that are very important to remember. And one is that it allows for the deferral of taxes on a capital gain. So it doesn't allow for deferral of taxes on ordinary business income. It must be a capital gain. And it must be a taxpayer that is selling a property, and that same taxpayer is buying another investment property. And we're going to clarify some of those as we go along. So the first thing we have here is a press release about a broker named Cheryl Savage from Northern California. And what Cheryl Savage did was she did a 1031 exchange. She sold a rental property that she had, and she bought a single family rental that she then used as her primary residence, which is not allowed in a 1031 exchange. She moved into the property that she purchased as her replacement property. And then she took it a step further, and she also falsified her tax returns. She knew that she needed to show rental income to defend that the property that she had purchased was indeed an investment property. So she falsified her tax returns with rental income. Well, the IRS got wise to this, and they came knocking on her door. And the first thing she did was plead ignorance. And she said, well, I didn't know about 1031 exchanges. It's my mistake, blah, blah, blah. And they went on her website. As I mentioned, she's a broker, or was a broker. And on her website, she mentioned that she knew about 1031 exchanges and could help investor clients with their 1031 exchange transactions. So they said, you can't plead ignorance. You as a professional are representing that you know the process. And so she had to plead guilty. She wound up paying over $120,000 in fines and restitutions, and she spent 14 months in prison. This is a felony. And the IRS and the Franchise Tax Board, particularly in California, take this very seriously. They don't like people who try to take a really good tool for an investor and fraudulently use it to their own gains. So, and because it's a felony, she also lost her broker's license, and Cheryl Savage is no longer able to be in the real estate business. So don't be Cheryl Savage. We can use this tool, we can use it correctly, and it can be of great benefit. So one of the biggest problems that people come into, and this is what Cheryl Savage did, is she traded into a property that was not a business or investment property. It's really important that the property that you sell and the property that you purchase are both business or investment properties. And you might say, well, what exactly does that mean? Well, this is not 100% all of the time true, but a great general guideline is that if the property produces income by holding, it's most likely exchangeable. So if you are collecting rents, if you're running a business, we can also exchange things like farms and ranches. So it doesn't necessarily have to be rental income, but as long as you're getting business income and the property is producing income by holding, it's most likely exchangeable. Now, we get a lot of questions about flips and developments. Obviously, people who engage in this kind of business can have very lucrative profits, and paying the taxes on them can be pretty stifling. So we get questions from a lot of people who are flippers and developers who want to do 1031 exchanges with those properties. The problem is a couple of things. One is that, remember when we did the definition of a 1031 exchange, and the purpose of a 1031 exchange is to defer the taxes on a capital gain. Well, for one thing, in order for something to be a capital gain, it has to result from the sale of a property that you've held for at least 366 days. Otherwise, it's not a capital gain, it's just business income. And even so, even if, let's say, you've had a property and it's taken you a really long time to flip it, problems came up that you didn't anticipate, or you've had a development, took you longer than you thought to build the structure on your property, or you've held the land for a long time and then you built a house on it before you were going to sell it. The problem is that these are considered inventory. They produce income when you sell them. In fact, the longer you hold them, they may even cost you money. So this is just like if you had a retail store and you bought raw product and you made it into something else and then you sold it. It's considered inventory, and it is most likely not going to be exchangeable. Sorry there. Okay, again, property qualifications. This is a big one for a lot of people. There is what's called a seasoning requirement. And we see this in the Internal Revenue Code, that the property must be seasoned as an investment property. The problem is that the tax code is not specific on what exactly that means. And they're looking at several things. But we're pretty sure that it has to be at least 12 months because of the capital gain requirement. If you haven't had the asset for 12 months, for 366 days, when you sell it, it's not a capital gain. It's just business income. So it's pretty safe to say it needs to be at least 366 days. But here in California, we also see from audit case history that the Franchise Tax Board likes to see 24 months. So we, as a company based here in California, and most of the exchanges we do are in California, we recommend to our clients that you hold that investment property for at least 24 months. That's the safest course of action you can take. Now, if you're a little bit short on that requirement, what we recommend is that you talk to your CPA, because in the year that you do your exchange, you're going to have to report it on your taxes, and your accountant is going to have to sign off on that tax return. And unfortunately, the problem some people run into is they have a short hold on a property, they do an exchange on it, and when they go to file their taxes, their accountant refuses to sign off on it because the hold was too short, and they never talk to their accountant. So seasoning is a biggie as far as a problem and a pitfall in an exchange. If you are short on the 2-year recommendation, please talk to your accountant. They know your financial situation better. They know if there's any mitigating circumstances. And we have this graphic down here because a lot of CPAs will say that as long as you report rental income on the property for 2 consecutive tax returns, they're okay signing off on it. So, but that's something that you need to have a personal conversation with your CPA or accountant and find out what they recommend. Another big problem, and I get people asking me these questions all the time. People know they want to do an exchange, and I was talking to a lady yesterday, in fact, who said, well, we're not ready to set it up yet because we haven't found our replacement property. And I was very quick to make sure that she understood that if you've already closed escrow on your sale, it's too late. And the reason for this is that there are rules in an exchange against constructive receipt of the proceeds. So if you sell the property that you're exchanging and you close escrow and you get constructive receipt of those proceeds, even if you don't spend them, even if you put them directly right into every penny right into that replacement property, if you have received those proceeds as the seller, you cannot exchange. You cannot do an exchange, and that capital gain is going to become taxable immediately. So, we see this scenario every once in a while where somebody opens escrow on their rental property and they know they want to do a 1031 exchange, and either they think that there's no rush, or they think that escrow is going to set it up. But they go ahead and they go through their escrow, they close escrow on a Friday, they get their deed recorded, they're really happy, they celebrate all weekend, they get their funds wired into their bank account. first thing Monday morning, they call Asset Exchange Company and say, I just sold my rental property. I want to do an exchange. And unfortunately, we have to tell them that we can't help you. It's too late. You've already received those proceeds. So the long story short on this particular problem and pitfall is that you must open your exchange before you close escrow on the sale. It doesn't have to be a long time before. Now, if there's any specific issues that we need to address and need to look out for, we hope that you'll give us at least, a couple of weeks before escrow closes so we can make sure all those things happen properly, and we can work with your escrow officer to make sure that everything's done according to Internal Revenue procedures. But as long as you open this exchange account before you close escrow and get receipt of those funds, and we can do it as soon as 24 hours if it's as long as there's nothing strange about the exchange. But the best course of action is as soon as you open escrow on your sale, give us a call, send us the information for your escrow officer, and we will set up your exchange with your escrow officer. And then you'll be good. Okay, another big pitfall, related party transactions. The IRS and the Franchise Tax Board want to see arm's length transactions. This is kind of just like when you have a short sale. What they don't want to see is that you're redistributing assets within a family. There are, a lot of different taxes and things associated with gifting assets and gifting cash to members of your family. There's gift tax, there's inheritance tax, there's a whole bunch of different things. And so a lot of times people get the idea, well, my son has a business and I'd like to, help him out with some cash so he can expand. So I'm just going to buy this piece of land that he has, and that way he'll get the money and he can do an exchange and not pay any taxes on it. Well, the IRS is kind of wise to that sort of an arrangement. And so honestly, it's kind of a strange thing to say, but the IRS wants to be satisfied that the purpose of doing your 1031 exchange is not to avoid paying taxes. Seems a little counterintuitive, but that's the truth. So there's a couple of ways that you can do a related party transaction where it will still be a valid exchange. So one is if each of the parties does an exchange. Another is if you have the parties buying and selling from each other in order to gain 100% interest in a property. So let's say you have children who inherited fractional interest in a property portfolio from their parent when the parent passed away. Say there's 3 kids, they each have a third interest in all of the parent's property portfolio. And they say, well, this is ridiculous. We're just going to buy and sell from each other so we all get a full interest in the property. You can do that, and that's a valid reason to do exchanges. And the other thing is if the party who's not doing the exchange gets a tax bill that's bigger than the one that was deferred in the exchange, then they look at that and they say, well, you obviously weren't colluding on this, or if you were, you weren't doing a very good job. So yeah, that's a valid exchange. So let's see. Okay, I have a question here referring to the last one about waiting too long. It says, if they find out at close of escrow that there's going to be an exchange. Oh, can you have escrow hold money if they find out at the close of escrow there's a 1031 exchange? And the answer on that is no, because your funds must be held by a qualified intermediary. And that is a company like us, who is a 1031 exchange qualified intermediary. So you must have that account set up. You must have your exchange documents signed and in your file by the time you close escrow. So like I said, we can do that pretty quick if it's a last minute fire sale thing and you call us up and you say we're closing escrow tomorrow. We don't like to get situations like that because we do actually at any one time have about 150 to 200 exchanges going on. So when we get a call like that, that means we kind of have to drop everything and get that paperwork done so that we make sure that the client doesn't close escrow before the exchange account is set up. but we can do it. So again, take-home message is, plan early. If you're selling a property and you get into a contract and you open escrow and you're doing an exchange, go ahead and call us, and let's start talking about it and get your exchange account set up so it's there whenever you do close. So hopefully that answered your question about that. Okay, so back to related party transactions. Again, if you're going to do a related party transaction, you need to make sure that you're both doing exchanges, that it's a valid exchange. Even though you may be related, it needs to be arm's length, so to speak. Okay, this is a big pitfall too. We see this different taxpayer requirement come up a lot, and unfortunately, sometimes it means that people just can't do an exchange, but there's two main instances where we see the different taxpayer pitfall derail an exchange, and one is in a divorce. So let's say that Joe and Jan own a property as husband and wife, community property. That's how the title reads. Let's say they have a little 4-unit building that they've had during the course of their marriage. It's been producing them income, and they've been claiming their depreciation and their income on their joint tax return. And as I said, the title reads, Joe and Jan Smith, husband and wife, community property. Now they're getting a divorce. And as part of the divorce decree, they're ordered to sell the property and split the proceeds. And they've had this property for a long time. They've been depreciating it, so they have quite a bit of taxable gain. And let's say that one of the parties, in this example, it's the wife, Jan, wants to exchange her half of the gain so she doesn't have to pay taxes on it. Well, unfortunately, if the property was held, if the title showed that the property was held as husband and wife community property, and the burdens and the benefits of the ownership, so that would be the rent, the depreciation, the expenses, the maintenance, all of that were claimed on a joint tax return, then after the divorce, a single taxpayer cannot do an exchange because they're different taxpayers. So you have Joe and Jan, husband and wife community property, owning the relinquished property, and then you have Jan Smith wanting to buy the replacement property. So the owners are not the same, and that exchange is not allowable. And unfortunately, the remedy to this is either we've had some people be able to do it because maybe even though they owned it together, maybe they were filing their income taxes separately. They were married filing individually. In that case, they may be able to make a defensible case that they had separate ownership, but that's kind of unusual. In most cases, when you have a property being sold in a divorce, unless those parties are willing to buy replacement property in the divorce and hold on to it to season it and then go their separate financial ways as far as their property is concerned, they're not going to be able to do an exchange because of the different taxpayers, because there is a same taxpayer requirement. The other thing we see this is in corporate ownership. So when we have an LLC or a trust, or any type of a corporate ownership of property, a lot of times people are selling the property because they want to dissolve the LLC and split the proceeds and go their separate ways. The problem here is, again, a different taxpayer pitfall. If the property has been owned and been in service as an investment property for Main Street LLC with Tom, Sue, and Mary as members, and then they're going to sell the property, dissolve the LLC, and take their separate proceeds. And then let's say Sue wants to do an exchange and buy another property with her proceeds. There's no exchange to be done because the seller of the property is Main Street LLC and the buyer of the replacement property is Sue Jones. They are different taxpayers, different taxpayer ID numbers. There is no exchange to be done. You have to have an exchange is done by a single taxpayer. So the same taxpayer who sells has to be the taxpayer who buys. there's a couple things you can do in a situation like this. If you have as a plan in your organizing documents that, let's say you're going to dissolve your LLC in 2019, then what you need to do in 2017 is you need to change the ownership interest of the property into tenants in common. So Tom would get a 1/3 tenant in common interest, Sue would get a 1/3 tenant in common interest, and Mary would get a 1/3 tenant in common interest. And then they can sell and exchange their tenant in common interest separately, no problem. Unfortunately, we usually hear about this when the property is already either listed or in escrow. And so at that point, if you want to do an exchange, what you have to do is keep the LLC intact. So if you need to buy 3 separate replacement properties in the LLC that you can later, after the 2-year seasoning requirement after the purchase, you can split and distribute one property to each member according to your operating agreement, and then they can go their separate ways. But the thing with an LLC-owned property or a trust or whatever is you're going to have to plan a little either on the front end or the back end because you have that seasoning requirement. So if you're going to drop down the ownership into tenants in common, or you're going to split the proceeds, you have to be able to season that ownership in order to do the exchange. So you either have to do it on the front side or the back side of the exchange. And we have a question here. Let's see. Would this also work for a married couple, change to tenants in common? It would, but the thing is, if they know they're getting a divorce, chances are they don't want to season a tenant in common interest for 2 years before they sell. And in many cases, you know, this is a court order that's telling them they have to sell the property and split the proceeds. And so they really don't have control over how it happens. Like I said, in most cases, when that's the case, what winds up happening is they can't do an exchange. I mean, unfortunately, it's not something people like to hear. Divorces are expensive, and this is another way that it's expensive, is it may rob you of your ability to do an exchange on the capital gain on your rental property. The most I guess, positive setup that you can have is, for instance, I was talking to a guy the other day who has been going through a divorce for about 6 years, and it's been really ugly. They have a lot of assets, but when they first split up, what they did is they started claiming all of the burdens and benefits on their separate tax returns, and they've been filing separate taxes for 5 years, and they've each been claiming their portion of the rental income, the depreciation, the expenses, all of that on their separate tax returns. So even though the ownership of the property still says, you know, Joe and Mary, husband and wife, when the divorce is finally final and they do sell the property, they're going to have a defensible position to say that they have separate ownership, even though the title says something else. But obviously, most people, when they're getting a divorce, you know, they don't want to hang on to the property together for the seasoning requirement. Here's, what about a quick claim into the individual LLC members before selling the property? Again, a quick claim, it's just as if you had dropped it down into tenants in common. In fact, that's what you're doing. And you're changing the ownership of the property. And that is something that when you report the exchange, they ask you questions about how long you've owned the property and such. So if the LLC executes a quick claim to give each of the members fractional interest, they still have only had that fractional interest for a short amount of time. So they're doing the exchange. Yes, they're selling. Yes, they're buying the replacement property. But when they report their exchange, they can only say that they've owned the property as an individual for, say, 6 months. Their seasoning requirement is not going to be satisfied. And this, by the way, is one of those things that the Franchise Tax Board, in case you didn't know it, we have one of the most aggressive taxing authorities in the nation here in California. The Franchise Tax Board is even more aggressive than the Internal Revenue Service. And they have issued a number of statements saying that LLC drop-in swaps are on their radar for exchanges. So you don't want to mess around with this. You want to do it properly. And you can go ahead and you can do that, and you can do your exchange. Nobody's going to stop you. You'll find an exchange accommodator that'll do your exchange. They may make you, in our case, if we do an exchange with a very short hold period like that, or something that we think will not stand up to audit, we may have you sign a document that says you've been advised against it, but and so you're taking on the risk should you be audited, or should your exchange be disallowed simply on your reporting, which happens sometimes too. And the thing is, you won't find out about it until maybe 2-3 years later. All of a sudden you get a letter from the IRS that says, we have decided that your 1031 exchange that you did 3 years ago was not qualified, and therefore you owe taxes. And it's just that simple. So you don't get a tax bill when you do an exchange, or you don't get a tax bill when you sell the property. You get a 1099. So if you do an exchange, you don't get a 1099. You go ahead and you do your exchange, and you report your taxes as normal, and you report the exchange as part of your taxes. And it may be several years before you find out that it wasn't allowed. And at that point, it's too late to do anything about it. So the most important thing is to realize that there are ways to do it properly to make sure that it will be defensible in the case of an audit, or in the case of a second look over your tax return, even if it's not a full audit. And particularly if the exchange involves a property held by an LLC, California is going to be looking at it. So it's really important to do that properly. And I can answer more questions on this topic in particular after the webinar. If you want, you can either email me or call me, and we can talk more about it too, because it is a pretty thorough topic. There's lots to discuss and lots of different situations. Our next pitfall is taxable boot. And we get questions about this a lot because there's so many different situations that can happen when you're negotiating a contract. There's so many different situations when people have property that they're selling in exchange, and maybe they've leveraged it, maybe they've used it to pay off other debts, maybe they've done any number of things. And one of the most common ones we see is what we have up at the top, where we have a seller who's selling their investment property, and they want to use some of the cash to pay off either personal loans or to do some sort of renovations on another property, or maybe they did renovations on this property and they want to pay off some of the people who helped them out. And the truth is that anything that you take out of your exchange, so if you decide I'm selling my property for $900,000, I'm just gonna, a lot of people say, well, I'm gonna keep $100,000 cash out of the sale, and I'll just pay taxes on that $100,000. You have to realize that yes, any cash that you keep out of the exchange from the sale will be taxable, and there's quite a tax package. So what some people don't realize is that there's actually not just capital gains tax, there's an entire package. So you have your federal capital gains tax, which if the taxpayer's income for the year is over $400,000, will be at 20%. So most people, particularly in Los Angeles, in the year they sell a property, are going to have income over $400,000. So that puts them at 20%. Then they have a 25% recapture tax on any depreciation they've claimed, which can be significant. They also have a 3.8% Medicare tax, which is federal. And then because we're in California, they also have to pay California state tax at whatever rate they're taxed for their ordinary income, because California doesn't distinguish between capital gains tax and ordinary income. To them, it's all ordinary income. So if you figure that's probably about 10%, you're looking at, for the sale of an investment property, anywhere from 35 to 45% tax. So you may think that you're keeping out $100,000 that you can use to pay off debts or whatever, but in reality, you're going to pay over 40% tax on that money. It's very expensive money. So if you can get that money anywhere else, it would pay you to do so. Even if you have to get a private money loan, a personal loan, even at, very high interest rates, you're going to be ahead if you get that money anywhere else. Call your Aunt Millie, call your best friend. It'll be cheaper if you can get it anywhere else other than keeping it out of the exchange. Same thing with buyer credits. A lot of people don't realize that when they're negotiating their contract with the buyer, and maybe there's some deferred maintenance on the property or anything like that, where the buyer says, okay, well, instead of doing the repairs, why don't you just give me a credit for $50,000? Well, anything that's a credit out at the sale, whether it goes to the seller, it goes to the buyer, it goes to anybody, is going to be taxable boot. So that $50,000 will become taxable. So your buyer credit of $50,000, if you add on to that what you're going to have to pay in taxes, is going to cost you a lot more. So again, if you can do something different, maybe you can reduce the purchase price for the buyer. And it's handy to know these things when you're negotiating the contract before you get to that close of escrow, because by then it's too late to change it. So anything that's a credit out on your final closing statement with escrow will be taxable. The third situation we have on the bottom is where someone sells their relinquished property for a higher price than they pay for the replacement property. And again, that's a partial exchange, but the difference is going to be taxable. So in this case, we have an example where they sell for $900,000, they purchase for $700,000. It results in $200,000 of taxable boot. And again, at about 40%, you're figuring that's going to be about $80,000. Probably something that you don't want to do. So even if you have to buy a second property, or you have to invest in something like a DST or a fractional, a TIC interest in something to get your investment up to that extra $200,000 into your reinvestment requirement, so that you're meeting your equal or greater value requirement, it's worth your while to structure it that way, to plan it that way, and do it. So, okay, let's see. Got a couple questions. With LLC, let's see. Okay, this is about LLC again. Can you purchase a property with LLC partners and make the ownership as partners in common? Actually, no, what you have to do is you have to purchase it in the LLC again, season the ownership for the required 1 to 2 years, and then you can drop it into tenants in common and go your separate ways. After the seasoning, you can do anything you want to with it. In the last example, can closing costs be factored in? Yes, the way closing costs are factored in is that you're looking at the net sales price for your reinvestment requirement. So let's say this little property here, which may be a duplex or whatever, actually sold for $950,000, but there was $50,000 in closing costs. So the closing costs that are deductible are going to be your broker fees, your escrow, title, exchange fees, anything that's a non-recurring closing cost can be subtracted off the purchase price to give you a net sales price. So in all of these examples, we're looking at net sales price. Let's see if we got anything else. Okay, perfect. All right, and if you have more questions on that, Barry, just let me know, like I said, and we can talk afterwards. Seller financing. This is something that in a regular real estate transaction can be very lucrative for a seller. If the seller has the means to carry back a note for the buyer, that can give them the opportunity to make some more money on the transaction. They can charge some pretty healthy interest on a short-term loan that maybe they can do a bridge loan for the buyer. The problem is, in an exchange, it becomes a pitfall. And the reason is, just like we showed in those other examples, anything that is not put into the exchange, anything that comes out of the sale that doesn't wind up in the exchange is going to be called boot, and it's going to be taxable. So in that example before where we had a net sales price of $900,000, let's say that the seller gets a buyer who says, you know what, I would like to buy your property for $900,000, but I'd like for you to carry back a $300,000 note. And in that case, if the seller wants to do that, there's two things they can do. They can either carry back that note, leave the money out, just put the $600,000 remaining into the exchange, and purchase their replacement property. But in that case, they're going to have to pay tax on the $300,000 as boot. The other thing they can do is include the note in the exchange. And what we mean by that is you assign the note to your exchange accommodator as the beneficiary. The note is placed into the exchange account with the rest of the proceeds from the sale. Now, you can either use the note towards the replacement property, and this is something, it's allowable in the Internal Revenue Code, but it doesn't really happen very often because it's hard to find a seller of your replacement property who will take a note from a third party that they don't know. So even though it's allowable to use the note as consideration towards the replacement property, it's not practical very often, and it doesn't happen a lot. Another thing you can do is replace the note with a cash deposit into the exchange account. So if the seller has enough liquid funds that they can replace the note with cash, that's most likely what they're going to have to do to not pay taxes on the money. They can also sell the note on the secondary market and deposit the proceeds in the exchange account. Or if it's just a bridge loan for the buyer, maybe they need to sell their own property before they'll have all the funds, then as long as they can pay off the note and the funds go into the exchange account before close, then that's fine. So the take-home message on seller financing is that if you don't want to pay tax on the amount, you're going to have to replace those funds in the exchange account one way or another. And that's important to remember. So if you don't have that money lying around on your own, it's probably not going to be in your best interest to carry back a note for the buyer in an exchange situation. Because again, unless that buyer is going to pay you 40% interest, you're going to lose money because you're going to have to pay that much in taxes on it. So it's something that really shouldn't be done lightly. All right, vacation rentals. Excuse me. Vacation rental, oh, let's see. Can one replace the note with a mortgage loan? You have to replace the note with cash. So no, you can't replace it with financing. Now, if you want to get a private loan that's not part of the exchange and put the funds into the exchange, you can do that. But no, you cannot replace it with a lien on the property. Hopefully that makes sense. Vacation rentals. These are things that we get a lot of questions about now too. I have quite a few people who have come to me and asked about buying replacement properties that they intend to use for Airbnb. I even had one lady who called me because her CPA had told her that she couldn't do that in an exchange. And I said, yes, you can. You can buy a vacation home for a vacation rental and use it for Airbnb. It doesn't have to be a residential rental, you know, as a primary residence for someone. It can be a vacation rental. Now, there are some additional qualifications for this. So it has to be owned for at least 2 years prior to the sale and rented for at least 14 days in each of those 2 years prior to the sale. That's the minimum rental requirement. And the owner usage is limited to no more than 14 days or 10% of the rental days, whichever is greater. So in other words, if you have an Airbnb and you rent it out 300 days a year and you as the owner use it for 30 days, then you're fine. As long as you don't exceed that either 10% or 14 days. and then you're good to sell your property or buy a property like that in exchange. Foreign sellers. We're all familiar with FIRPTA probably. It stands for Foreign Investment in Real Property Tax Act. Now, the purpose of FIRPTA is that Uncle Sam doesn't want someone who's a non-U.S. person who owns property in the United States selling that property and cashing out the proceeds and running off to wherever they came from without paying taxes. So what FIRPTA establishes is a withholding requirement. This is just like if you have a job where you get a paycheck, you get W-2 income, and you have to, your employer withholds a deposit against the taxes that you may owe on that income at the end of the year. That's exactly what this is. It's a 15% withholding requirement, and it's actually required of the buyer of the property. So what it is the buyer of the property is required to withhold 15% of the proceeds, or 15% of the purchase price, excuse me, and send it to the IRS on behalf of the seller, unless the seller presents a seller's affidavit, which is when you do a real estate transaction, the seller is given a form called a seller's affidavit where they certify that they are a U.S. citizen or they're a U.S. taxpayer, they have a tax ID number, and that they file U.S. tax returns and they're going to pay their taxes, in which case there's no requirement to withhold this money. Now, what if you're a foreign seller, but you're doing a 1031 exchange? Well, first of all, can a foreign citizen do an exchange? Yes, they can. Now, what happens is, okay, let's say, especially if this is a big transaction, you don't want that 15% withheld. The seller doesn't want 15% of their proceeds withheld if they're going to do an exchange and they're not going to owe any taxes. So there's a different form. We don't use the seller's affidavit. It's called a withholding certificate. And the foreign seller applies to the IRS to get a withholding certificate. And it's that form that we saw on the last page, the 8288. They fill this out, and on this form, they report that they're planning on doing an exchange. They talk about the property. They talk about who's buying the property, so you have to be in contract before you apply for it. And when they get this withholding certificate, they present that to escrow instead of the seller's affidavit. So it says, yes, I'm a foreign citizen, but I'm doing a 1031 exchange, so no taxes will be owed. And then escrow knows they don't have to withhold those funds. Now, it can take several weeks to get this certificate, so you need to apply for it as soon as you enter escrow. And if you don't get it in time, you can present to your escrow officer the form 8288 showing that you have applied for it, that you're going to do an exchange, and there is no requirement to withhold funds. Now, what happens if you don't get this in and the funds are withheld? So if you're a foreign citizen and you're doing an exchange, but you didn't get the withholding certificate in and you didn't get the 8288 form to escrow, and they went ahead and they withheld the 15% funds. Well, it's not the end of the world. It means you have to file a U.S. tax return and you'll get them refunded. But obviously, if it's a large amount of money, if it's several $1 million, you may not want to wait the time it'll take to get that refund. So long story short, if you're a foreign citizen doing a 1031 exchange, or you're an agent and you're representing a foreign citizen doing an exchange, make sure that they apply for their withholding certificate and get that paperwork into escrow so that their funds will not be withheld. Hidden gain. This is another big pitfall that we find, is people don't realize, they have a misunderstanding of what the definition of gain is. And very simply, gain is the difference between what you have in the property and what you're getting out of it when you sell. So more specifically, it is your net sales price, which we discussed before. So that's the sales price minus your non-recurring closing costs. So your net sales price minus your adjusted basis. And there's a couple of things that adjust your basis. One is it starts off as your original purchase price, and then you add in any capital improvements that you've done, and then you subtract any depreciation you've claimed over the years. So if your property is fully depreciated, you can have a very low adjusted basis. So if you've held that property for 20, 30 years, your basis can be very, very low. And we're going to look at a couple of examples of this that hopefully will illustrate it. So here's an example of hidden gain when you have taken a loan out on the property. So let's say you originally purchased this property 30 years ago for $300,000. You can see this is a nice little duplex. Maybe it's in Long Beach or something. And you purchased it 30 years ago for $300,000. Now today you're going to sell it and your net sales price is going to be $900,000. But you leveraged it a few years ago. Maybe, you know, your daughter was getting married, you needed to put a new kitchen in your house or whatever. So you leveraged, maybe you wanted to buy another property. So you leveraged this one for $500,000. So your cash out at sale is only going to be $400,000 because your net sales price is $900 and your loan due upon sale is $500. So your cash out at sale is going to be $400,000. That is not your taxable gain. That's your cash out at sale. They are two completely different numbers. Your taxable gain on this property would be $600,000 because it's your net sales price minus your adjusted basis. So sometimes it's difficult to understand that when there's a loan on the property, but this happens all the time. The loan does not come into the calculation of gain at all. In fact, if you look at this next example, you can even be upside down on the property. So let's say 30 years ago, same individual, same property, purchased it for $300,000. And his net sales price today is $900,000. But let's say 2004, when the market was ridiculously high, he decided to leverage this property for a lot. He took this property he originally purchased for $300,000 and he leveraged it for $1 million. Or maybe it's more, maybe there's more than one loan on the property. So he's got $1 million worth of loans to pay off on sale. So even though today he's selling it for $900,000, his cash out at sale is going to be negative. He's going to have to bring money to the table, $100,000. He still has a $600,000 taxable gain. And at that tax rate, when you add up all those taxes, he's going to wind up paying about $200,000 in taxes minimum when he's bringing cash to the closing table. Because again, loans have nothing to do with your taxable gain calculation. It's your net sales price minus your adjusted basis. So hidden gain can be a huge pitfall for people, particularly because they might not think that they have gain. They might think that since they're upside down on the property, they have nothing to be taxed on. And they won't find that out until later after the transaction is already done. They're filing their taxes or they're getting audited or whatever. And the IRS comes back and says, no, you had a taxable gain of $600,000 on that property and you owe taxes. So that's a huge pitfall. And it's really important that people understand that the cash out at sale is not the same as your gain. Question, can you shoot the last slide again when you're done? Okay, everybody who is on this webinar will get the slides after the webinar, so don't worry about that. I will send you this entire presentation in your email afterwards. And like I said, if you have any further questions or anything, don't feel in the least bit hesitant to send me an email or give me a call and we can talk about it in more detail. So that's basically it. We're coming up here on an hour. Thank you so much for spending time with me. You might wonder, what does an exchange accommodator do? So as I mentioned, you want to get your exchange account set up before you close escrow. That was our first pitfall, remember, is not setting up your exchange account in time. So we work with escrow to drop your exchange paperwork, and you sign all your papers through escrow. We drop all the paperwork, we get it back to your escrow officer, and they will have you sign it along with all your other papers that you have to sign for your sale. We ensure that everything is in compliance with the tax code, and we'll let you know if something isn't. We'll also keep you on your timeline. So your identification requirements, your 180-day requirement, all of that stuff, we will remind you, we'll keep you on schedule, and give you any help that you need with that stuff. We hold your exchange funds in an FDIC-insured money market account, and we distribute the funds at the completion of the exchange. Anything that's going into the purchase of your replacement property, if anything's coming out to the seller or anyone else, we distribute all of those funds. And then after the exchange, this is something that Asset Exchange Company does that other ones don't, is we do audit support. So one of our partners is a licensed tax attorney, and he ensures that your exchange will be defensible in audit, and we support you in that. We'll make sure you have everything that you need to show that your exchange was valid and allowable, and we'll stand up to that audit. So again, here's my contact information. I love to hear from people after the workshop with specific scenarios. So if you have something that I didn't cover or that you need covered in more detail, feel free to email me, call me. My direct line, the 213 line, is my best one. And also I will be out of the office today on the road. So make sure you call me on my cell if you call me today. And thank you so much for your time. Thank you for attending, and everybody have a great weekend. I will talk to you soon. Bye-bye.